Understanding index funds.
Index funds are investment funds designed to match the performance of a broad market index like the S&P 500. Instead of trying to pick individual winning stocks, index funds invest in many companies at once, making them a popular choice for long-term investors who want steady growth over time with less work and lower costs.
The power of diversification.
Diversification means spreading your investments across many different companies and sectors. By not putting all your money into just one stock or industry, you reduce the impact that any single company's struggles can have on your overall investment. This approach is a key principle in reducing risk and protecting your money.
How index funds lower risk.
Because index funds automatically invest in a wide range of companies, they offer instant diversification. If one company in the fund performs poorly, its losses are often balanced by gains from others. This broad coverage makes index funds less risky than betting on just one or a few individual stocks.
Why index funds win over time.
Research shows that most actively managed funds, where experts try to beat the market, often fail to outperform simple index funds over the long run. Index funds are cost-effective, easy to maintain, and historically provide returns that match the overall market, helping investors build wealth steadily and reliably.
Simple investing for everyone.
Index funds make investing accessible for everyone, even beginners. By offering built-in diversification and lower fees, they help reduce risk and financial stress. This allows everyday people to participate in the growth of entire markets, making index funds a smart foundational choice for most investment portfolios.